Hello and welcome to the Economist Board for our March 2024 watch report. We've been doing this for several years. It's hard to believe we're already up to March 2024 doing these things, Keith.
That's incredible. Yeah, absolutely. Years flying by.
Hey, folks, I'm John Nelson with M&A, and I'm joined today by Keith Prather of Armada. We've been partnering together for the last several years, myself, Keith, and his partner, Chris Kuehl. And we're really grateful to have the opportunity to bring you these videos where we're going to provide some additional context to the models that we put in the watch report, and hopefully get a little extra narrative that'll help you understand how to use these things and make business decisions, because ultimately that's what they're for.
Yeah.
So in this video, we're going to focus on industrial production for manufacturing. And then we have several other videos that you have to be a subscriber, take a look at. So if if you're either a subscriber or if you're not, get yourself on trial so you can see them. We'll have an opportunity to take a look at the transportation of goods. We'll have an opportunity to take a look at the construction sector, as well as doing an overall macroeconomic outlook that will include consumer spending, which this was something that Keith taught me, that's 70% of our overall GDP is as a result of consumer spending. So with that wonderful intro, I know you're all just enraptured by listening to me on whatever morning or afternoon it is. We're going to jump right in it. You ready, Keith?
Let's go. Let's roll.
Okay, so we're going to start off with industrial production, and let me go ahead and pull up the slide, make sure I get the right one.
John, while you're doing that, this is the reason why we pulled this one is because this is the broadest measure of manufacturing, stretches across durable and non-durable goods. So this is basically the proxy for what's going to happen in the manufacturing sector.
Got it. Okay, so if you see me looking slightly to the left, folks that are looking at this on online, what that means, I'm looking at my other screen over here so I can see what I'm trying to point out to you. And right now, IPMAN has been doing what it's been supposed to be doing. I actually have the long range lookup that Keith will talk from, and I'm going to go to the previous screen for the short range. You can get a little tighter granularity on the report. And if you take a look at the difference between this month's projection and last month's projection, it's kind of a good example why you should be looking at the watch every month. And that, we're pretty accurate, especially out to 6 months out. We're somewhere up in around the 96% on this thing. But if you take a look, the next 6 months, you see this increase, which both the February report and the March report are showing. But now we're starting to take a look, and we're seeing signs in the economy and in the different metrics that there's going to be a little bit of a taper off, where we thought it was going to hang closer to the index at 102 all the way out to 18 months. We're starting to see those signs where it's going to drop off to about 100 at that 18-month mark. So in a tighter period of time, is a little bit more volatile than what it was. But I also want to draw your attention to the wide kind of cone looking thing on here. And this piece right here, this is that where we think the forecast could be anywhere inside of this line, anywhere inside of this line, most likely right along the orange. And if you take a look at where this forecast is falling now, it's still well within what we had predicted in the past. So with that, I'm going to send it over to Keith to talk to you about how this looks over the context of the last 20 years.
Yeah, I mean, this was an odd one because it at first it doesn't signal any challenges in 2024. You look at the growth rate on manufacturing, and it's what we really have been expecting. We knew that over the last 18 months, we've talked about this a lot in our videos, that we've had kind of a global inventory glut, and a lot of manufacturing has really been capped off and been kind of shut off because a lot of companies could really feed off of existing inventories. And so 2023 was that destocking period. And as we look like the global PMI surveys that come out every single month, now we're finally getting those signals that a lot of that destocking trend is over. And so this lift that the model is seeing in the first half of 2024 makes a lot of sense. Going into the peak season, we see manufacturing starting to recover and go back and surge a little bit. what really surprises us, John, you and I talked about it, is really that back half drop. And it's not recessionary. It's almost reverting back to what would feel like more of a kind of like a normal period if you go all the way back to 2016 and 2017. Um, so again, not recessionary, but it is the model is picking up a lot of pressures that give it that downside, what we call a downward bias. And that downward bias is a little concerning. If I go back, and we've talked about this many times, if I go back to the 2014 to 2016 period, let's see if I can draw at the same time. But if we go back to this period here, this was a similar period where we had inventory overstocks that surged in 2014, and then we saw the transportation sector and we saw we saw manufacturing generally kind of do this dive up until about 2016, and then we saw the recovery. And I know as we talked about transportation, and you talked to transportation companies, they saw a surge in some of the best supply chain activity they've ever seen, going all the way out to about 2018. So it's kind of just interesting how that all works. And so we think we're in a similar cycle, but we're a little nervous about that back half and that sort of flattening out of the manufacturing activity. And that could be when we move back into more of a just-in-time kind of environment where we have okay macroeconomic demand. We're growing a little bit less than 2%. Um, you know, Products are still selling, but not maybe at the rate they have been over the last few years. And so because of that, you get a little bit of softer manufacturing activity. And I think that's part of what the model's picking up. But we've got some scarier signs coming up in some of the next two models.
So can I ask you a question before we jump over to the other two models? Could I ask you a question? I'm going to put you a little bit on the spot.
Sure.
Of course, if you notice, the data on this was drawn on the 13th of March, and so the forecast was built off of that. But then reading in the paper this morning, and the day that we're doing this recording, folks, is the 19th of March. And I'm just reading where it's expected that the Fed, rather than do 2 interest rate or 3 interest rate adjustments, they may only do 2. That's the Fed meeting right now. If that holds true with the with the inflation staying stubbornly high, how do you see that impacting the models moving forward?
Yeah, I don't know.
Your best Karnak the Magnificent on that one.
Yeah, not a problem. And I would agree with that forecast. The Federal Reserve had already told us they were going to give us maybe 2 quarter-point cuts, maybe as high as 3 this year. But when you do look at some of the macro data, especially the jobs data, and we look at some of the GDP growth rates, the economy is still pretty hot. We also got some inflationary data that was elevated, as you said. And so that really is probably going to push the Fed definitely off of this meeting. Meeting actually happens tomorrow at the time we're recording. But then it also may put into question the June meeting. And the June meeting would be next real opportunity for a cut, or April, May, and then kind of into June. So I don't know that that has a bearing on this particular model. What keeping interest rates higher for longer would do, it looks like, is slow down the durable goods category. And that's going to be important when we get to the primary metals model in a couple moments, because that, I think, is what's directly putting pressure on the durable goods model. But as we've seen in housing, it's like single family housing is starting to take off again, even with higher interest rates, because a lot of buyers have found a way to get the cost of a home, like the actual square footage or the materials being used to build new homes, to get that down to a point where buyers can jump back into the market. And there's still fairly shortage of inventory, a fairly moderate shortage across the nation, especially in some markets. So the housing market's still doing well, even though it's interest bearing. But other interest bearing types of spending are starting to feel that pressure. And so the model could be picking that up. I know we use 22 different economic metrics in each one of these, and it could be seeing those higher interest rate signs and picking some of that up. We pick it up in the treasuries, we pick it up in a number of different areas, as part of the equation, or part of the skunk works that goes behind the scenes in this. So
Sure. All right, you mentioned primary, and this is primary metals. So again, Same type of situation as with IPMAN. You're looking at the general curve looks about the same, but like IPMAN, a little bit more of a tail off on the back half. It was already going to start tailing off down to about the 92, 93 level at 18 months out. But now we're looking at a little bit more significant drop off over time. So still well within what we thought variability. And this is traditionally a pretty volatile model or a volatile sector. So, in the short term, that's what that looks like. In the long term, that cliff looks pretty bad.
Oh my gosh. I mean, that's a 15-point drop almost, 12 to 13 points. And yeah, this is one of those slides, John, where we almost don't even want to talk about it. I mean, I don't want to stick my neck out there. But you and I have learned over time that we've really got to pay attention to whatever the model is seeing and what's pressuring it, because it's using, thousands and thousands of calculations that you and I, can't necessarily keep track of. And so, I don't like the downward pressure that we see in this model, but like other times that we've gone through primary metals before, it doesn't seem to be tying directly to all the other industries that seem to create demand for it. So it almost is signaling, the model is almost signaling that it's picking up a surplus of supply, like it's seeing too much supply, not enough demand, and so it drops off a cliff.
Mhm.
Even though this specifically is a demand model, it's the factors inside the model, that are looking at supply and demand, the push and pull there, and it's just showing a lot of weakness. So I don't have a lot of great reasons. This primary metal sector is really going to largely uh, reference the steel industry, steel production. There's a lot of steel pipe and tube involved in this, coil, cold steel coil. So could be a little bit of the automotive sector and a little bit of slowdown that we see in the back half of the automotive demand. Could be part of what's going on in aerospace, a little bit in construction perhaps. But this is scary because historically this would almost be giving us a little bit of a recessionary signal.
So the one thing I did want to point out, and maybe you can comment, the first blush, you're thinking it's kind of a one-off and maybe they're crazy, but if you look at other periods of time right here, especially in this period of time, which is followed up by the next one, and in here, and then in these two drops, the kind of drop that we're talking about, and I'm avoiding the Great Recession, I'm avoiding COVID. These
Right.
other drops during the different economic periods are consistent with about the size of the drop that we're seeing here in terms of it's not outlandish, but is there something that's worth commenting on about those comparative periods?
I don't know if I have anything specific. I know that the steel industry can be volatile. There can be moments of um, challenges in the supply chain or challenges in output, but I don't have anything specific in those times. Each one would have been hit with something a little bit different. Prior to the pandemic, we had construction of all types really booming, and there was a significant surge in those. After, I'm sorry, I said pandemic, Great Recession is what I meant. And then, as we kind of got in that period between the Great Recession and the pandemic, you had other things like cash for clunkers, which threw a curveball into the automotive industry. But we saw automotive production surge and a lot of different things happening kind of throughout that whole period. And so each of those down cycles or those up cycles, kind of being generated or kind of stimulated by different factors. We've got the Infrastructure Act that's kicking in, and we know another $50 billion in spending on street level projects is going to be kicking in throughout most of this year. And then we get one last, I think one or maybe two more $50 billion tranches that kind of kick in 25 and 26. You've also got other types of spending that would theoretically kind of create a little bit of a surge for steel, but the model's seeing something drop off, and that's why I went to durables. I think it's on the durable side, and
Okay.
primarily really watching automotive.
All right. Well, let's take a look at fabricated metal. It's a little bit closer in to where the supply chain. And the first thing that I'd like to point out is something that you and I were talking off camera. We'll see it a little bit better when we get to the long term, but these seem to be going in opposite directions. First of all, fabricated metal outlook looks a little bit better than what it did last time. Not tremendously better, but a little bit better. It kind of has the same shape, but just tilted up a little bit. But when you take a look at this, you're thinking, boy, why is fabricated metal improving and primary metal dropping? And so you kind of see that this, if you remember the primary metal slide, it was a lot more volatile. Those peaks and valleys were all over the place, with multiple peaks and valleys in between some of these years. And here you see the fabricated metal chart's a little smoother over time, and the movement of it is a little smoother over time. And what we noticed was it's just that primary metal is more volatile. And sometimes they're going to, in general, they'll move together over time. If you look at moving averages, for example, but in a short period of time, there definitely can be periods when they move against one another.
Yeah, and one thing that I thought of, John, and as I think back, it seems like if you think about primary metals as a feeder into fabricated metals, and then fabricated metals as a feeder into other durable sectors, we always talk about the fabricated metal sector being driven by all the other sectors in the model.
Mm-hmm.
One thing that we know happened a little bit over the last quarter or two is that we saw a lot of primary metal supply being fed into fabricated metals, and you see inventories build in the fabricated metal sector. So it's possible that you see this kind of demand curve and you see this output coming out of fabricated metals, but because they're feeding off of existing inventories of metals that are in stock, they're not going in and sourcing primary metals to bring that inventory in.
Yeah.
And so I think there's a little bit of a difference here in inventory levels and what that does to demand. And so that makes a little more sense to me than some of the other things we're looking at, because I do think for those who tune in and look at the other presentations that we've got coming up in other videos, those durable sectors are not struggling like we saw with primary metals a minute ago. You don't see a lot of those industries falling off a cliff. So demand for finished goods is still pretty strong, and it looks like it's going to be pretty good, at least for the near term over 2024. 2025 is a different story. But and I think that's why you see this lift and why this is absolutely entirely possible.
Gotcha. Okay. Well, that concludes our look at industrial production, as well as two major portions of the supply chain going into it from the primary and fabricated metals. Hope you enjoyed it. We'll see you again next month.
All right. Thanks, everybody.